record. All right, so today we're going to be talking about some things to pay attention to in your portfolio, and that's avoiding overlap and co-mingling of assets. So we'll go ahead and get started. So a lot of this is going to revolve around the mutual funds. So a lot of 401k, 403b type positions, where mutual funds are primarily the only investment choice that you may have. And so this is where the avoiding overlap and commingling come into play, but overlap also comes into play with regular investments as well. So you just want to be aware of those two things. So before we get started into that, let's talk about what a mutual fund is and how they work. So what a mutual fund is you have individual investors. That's me, you, anybody that might be investing in a 401k or whatever account it might be. And we all pool our money together and we give it to this fund manager. And this fund manager is the one who decides which securities that mutual fund is invested in. So that manager invests in the securities, and of course the securities generate returns. It could be positive or negative returns, and those returns are passed down to us investors. So picture, if you guys have been around Gage or Rich, I'm sure they use this analogy where they have a cup and they just fill it with a bunch of pins. Right, that's kind of what a mutual fund is. A mutual fund is, I wish I had a cup near me. Here, I have a paper clip box, right? So this box is the mutual fund, and what they'll do is they have all these different paper clips, right? And they just throw all these different funds into this mutual fund box. And so you end up with just a bunch of different, let's see if that works there. So just a bunch of different funds in this mutual fund box. And then they just package it all together. And that's the mutual fund, right? That's how they work. So when we talk about mutual funds, you'll typically see a style box. And this is very common. Mutual funds will have a name. They'll be, American growth funds. They'll have some type of large cap growth or mid cap growth. And you'll see this many times in your 401k portfolio or your options within the 401k. They'll break it down into, here's your large cap positions, here's your mid cap positions, your small cap positions. They might have international or, income bond type positions as well, your fixed income positions. And so they kind of break that down. That's all based off of the style box. So the style box, there's couple things to look at here. You have different types of positions. You have value positions, blended positions, which are kind of mixed between value and growth. And then you have your growth positions. And they can be small cap, medium cap, or large cap. And so typically what you'll find with a mutual fund is if you go to finance.yahoo, let me see if I could pull that up real quick and just give an example. On the side here, but you can go to a fund name and it will show you what style it is. So let me pull that up real quick and then I'll move this over to the screen. So we're looking at Fidelity Contra Fund, and typically let's see where it is, or the category. I think they just list the category. So it's a large growth. So we know the style box for this particular fund is going to be a large growth position. I know they used to, and they still may in one of these areas. I think it might be in profile. There we go.
There it is. Yeah,
so there's the Morningstar style box. It says, this particular mutual fund is a large growth mutual fund. So you just follow the axes there and you get that. So that's important to realize because a lot of these mutual funds in your portfolio might be the same exact style: large growth, large growth, large growth. And so you just want to be careful and try to avoid that overlap, because what we'll find when we open the door on a lot of these mutual funds is they're all invested in the same exact companies. And so there's two different types of overlap, right? There's a style overlap, meaning you have large cap growth mutual funds, multiple of them in your portfolio. So you have a style overlap. And then you have a position overlap where all of these mutual funds are investing in the same exact companies. And you got to be careful of that because that creates a lot of internal fees. That's what mutual funds do. They have fees and other things that are associated with that. And so let's jump into, I just want to jump into some more examples. There's a unique website, morningstar.com. That's another one that is used very often. Morningstar is a very well-known entity that breaks down and does some analysis on a lot of these different funds. So we'll just look at some common mutual funds. The Vanguard Growth Index Admiral, right? Everybody's heard of Vanguard. And so you can look at this fund and they break the style box down for you. Now this is a large growth mutual fund. And so you'll want most of that position to be in this large growth. And so you see about 60% of it is in the large growth position, 26% in the blend, but you also have about 12% that are in medium and large value companies. And so when we talk about style drift, you'll find a lot of these mutual, or I won't say a lot, but there's a good number of mutual funds that say they're a large growth company, and you may only see 30 or 40% of their positions are actually large growth positions. So they're not necessarily investing as their name applies. And as mutual funds, it gets a little tricky there. So just be aware that one's open there for you. So let's look at another common one, American Growth Funds of America. Again, this is another growth mutual fund. And they have 53% of the positions in a large growth, and you're starting to see a little bit more dispersion among these other holdings. Do what you will, but if I'm wanting a mutual fund to be in large growth, I want to see more than 50-60% of the holdings tied to that area. So let's look at a mutual fund that we use quite often with some of our clients that do this, and this is a Poland Growth Institutional. You can see the ticker there. Now they are very focused. This is what we want to see when we're looking and trying to avoid this overlap in style drift. Is 80% of their holdings are large cap growth holdings. That's very important because it's doing exactly what this mutual fund implies. So we can be investing in this one mutual fund for our large growth. We might want to look at a mutual fund that might be a mid cap, but this is what we want to see. Is there's no holdings here in any of the smaller, medium or mid cap in the value or blend. It's all strictly, for the most part, in the large cap growth, large cap blend, and then just a little bit of some mid cap positions. So this is what we want to see and focus at when we look inside these mutual funds to see what they're invested in. Okay, and so that's why we look at this style drift and overlap. And what I mean by overlap is, through our RIA, we're able to do what we call portfolio audits. Now, within these audits, they're breaking everything down. They're opening the book on all these mutual funds, and they're saying, okay, this is what mutual fund A, B, C, D, etc. are all invested in. And this is an actual client of ours that we did an audit on. And you can see that there is a significant amount of overlap. There's a lot of different holdings here on this right side, and we can see that he had multiple holdings that were owned in 13 or more funds in this portfolio. Now, what do you think that does? If you have 13 different or 16 different mutual funds all invested in the same thing, well, you're creating a lot of transaction costs. A couple months ago, we did the this market update, and we talked about avoiding turnover. And one of the things that we talked about was the mutual fund fees and mutual fund expenses that you don't always see, right? We know that mutual funds have an annual expense fee, but there's additional hidden fees that we may not see. You might have mutual fund A is invested in Apple, mutual fund B is invested in Apple, right? Mutual fund A is saying, hey, we're selling Apple stock. Mutual fund B is buying Apple stock. That transaction happens. And guess what? Every time that you sell and buy out of a mutual fund, there's additional expenses that happen. And you as the consumer don't see those. That's all done behind the scenes. The only fee that you really understand and know about is just that annual expense fee that's required to be disclosed to you. But all the things that happen behind the mutual fund, trading and other types of things that happen, you don't see. And so when you have a lot of this redundancy between holdings, it ends up creating a drag on your growth. We'd like to see, maybe one or two holdings might have these positions. At best, we only want one mutual fund, or, to have each one of those holdings. We don't want 3 mutual funds all having the same holdings. It doesn't make any sense, and it just creates a drag within your portfolio.
Brandon, let me just jump in real quick to clarify that this audit was done on a portfolio before they met us. In other words, this isn't our portfolio.
Correct. Yeah.
This is what they had before. And so, yeah, just wanted to clarify that this is where they were, and our education process was to make these more efficient. So
correct. Yeah. We try to practice what we preach. So yeah, this was the portfolio before, and they're a client of ours now. But it's pretty amazing to see, and this was eye-opening for this individual as well, just because they understood that, yeah, this wasn't the best positions to be in that situation. Now I'm going back. This slide is the slide that we had in a couple months ago when we talked about the avoiding turnover. And so you typically have the potential cost of owning a mutual fund. You have the disclosed cost, which is the expense ratio. That's a known number. You could find that on finance.yahoo very easily. So we'll just jump back into that Fidelity Contra Fund. And you just go to the profile, scroll down, and you'll see the fees and expenses. The annual report expense ratio, it's 0.86. So every year you're paying 0.86 to be invested in this mutual fund. Now, again, that's only the disclosed fee. That is not the entire fee for that position, right? Because all these hidden trades that we're talking about, and with overlap, all these trades, you have mutual fund A buy-in, mutual fund C sell-in, and that's just creating that internal and hidden trade. And within mutual funds, that average is close to 1.4% of additional fees that you don't see per year. And then that leads into a tax inefficiency. Mutual funds are not a tax efficient position. If you're in non-qualified accounts, there's a lot of other options out there for you that are better suited to help you with your tax efficiency. And then, of course, there's sneaky behavior within mutual funds as well. A lot of times they'll sell losers. If a mutual fund, to make it look like it performed better than it did, they might get rid of the positions that weren't doing well, and then they'll buy the positions that were doing well. There's risk shifting. Again, this is saying, this is what the mutual fund state it's going to do, but we're not performing well, so we're going to add these few additional riskier positions, but they're doing well right now. So just be aware of those types of things as well. But there's a lot of hidden fees within mutual funds that you as investors may not see. So what are the options with that? So when we talk about commingling of funds, now mutual funds, I'm not saying that they're a bad investment. I don't want to say that at all. But typically, mutual funds they were kind of designed for a smaller investor. If you don't have a lot of money, you're able to put your money into this position and have it kind of broadly invested for you, across many different positions. So we'll go back to this little chart and we'll kind of hit on the commingling. I feel like the overlap part covered that pretty well. Yeah. So with the commingling, and that's exactly what you're doing with a mutual fund. Since you're pooling your money together with other investors, you're basically just mixing all your money together, sending it to the fund manager, getting securities, getting those returns, and then The cycle just repeats with the mutual funds. The downside to that is mutual funds themselves are very tax inefficient. And we'll jump into that and look at some other different options here. So there's something called SMAs, or separately managed accounts. There's mutual funds and there's ETFs. Those are the three most common choices of investments that people have. So let's look at each one of these individually real quick. As far as the ownership, a separately managed account, kind of picture it almost as a mutual fund. But instead of investing in the mutual fund, you are directly investing into those individual securities. So with a mutual fund, you own the shares of the fund itself, but you do not own those individual securities. That's a big distinction between those separately managed accounts and mutual funds. And then there's this newer thing called exchange traded funds. Those are a little bit newer to the scene. Very similar to mutual funds in that sense. You own shares of the ETF, but again, you do not own any of the underlying securities that the ETF is invested in. And so this is very important to understand as an investor. The downside to separately managed accounts is typically there's a higher minimum to get invested into those positions. These are typically run or managed by these institutional managers that do this for large corporations, and now individual investors through their financial advisors, if they have the correct licensing, can get access to these SMAs at a much lower introductory price.
Brandon, let me just throw in real quick. I like to say mutual funds are like buying retail. ETFs are buying retail on sale.
Yeah.
And the separately managed account is buying wholesale.
Yeah.
And when you go to a wholesale warehouse, you got to buy bulk. Where if you do the retail, you can get your little bits, but there's a whole lot more pricing built in. Or if you get it on sale, that's an ETF. So do you want wholesale, retail, or retail on sale? Anyway, I just thought I'd throw that in.
Yep. No, that's a great point. And so let's look at the next little section down here in customization. With mutual funds and exchange traded funds, there is no customization. You're invested in whatever the manager decides he or she wants to be invested in. You can't say, hey, Mr. Manager, I don't want to be in this particular fund. Maybe I don't want to be in I don't want to own any pharmaceutical companies, or I don't want to own any companies that, do this or that, or that promote this or that. But with separately managed accounts, you're able to say, these are the type of securities I want, and I don't want to be invested in these pharmaceutical companies. Well, under the SMA, they can remove those pharmaceutical holdings, and you can still have the other holdings. So very, very awesome in the sense that you can customize and you can be invested in what you as an individual want to be invested in. And because of that, there's a big tax efficiency. Again, when we're talking tax efficiency, this is going to be for those non-qualified accounts. Any IRA, 401k, any qualified type account, you're just going to be taxed once you distribute that money. But there's no, real tax play that can go with those. But for non-qualified accounts, this is very huge with separately managed accounts. With SMA. So let's look at, I'm going to pull up this last slide, or this here. And so what I mean by tax efficiency, let's say we invested in the S&P 500 and we own each one of these holdings individually in an SMA roof. Now last year, the S&P was up 17.88%. Okay, and let's say we want to realize some of those gains. Well, how do we, in a tax efficient way, get rid of some of our winners and not have such a huge taxable exposure? So what we do under an SMA type account to reduce and limit that exposure, that tax exposure on a non-qualified account, is we're going to sell some of these winners, right? We're up 17.88% as a whole. And what we're going to do is, this is going to create some type of capital gain tax, right? Well, what we do is we scroll all the way down here, because do you think every position in the S&P 500 was up last year? Nope. So we scroll all the way down and we look at the losers. So what we're going to do is we're going to sell some of our winners and we're going to offset them by selling some of the losers. And so what that does is that offsets some of your capital gains with losses. And ultimately that reduces the taxable exposure on the account. Now it's okay to do because you're still up 17.88%. Just because you sell some of the winners and some of the losers doesn't change that. We're just looking at a way to reduce that overall tax exposure. And so SMAs are very customizable, very tax efficient. And so when you have enough money to be able to invest in these, ultimately that's what you want to have in your portfolio. And you can see here, this is why some people may not be able to get into SMAs. Those that are working with 401ks, you're limited, right? You're limited to mutual funds. That's what your 401k plan allows for. But if you're able to, and once you retire 59 and a half and are able to move that 401k out into an IRA, that's where you can start looking at those separately managed accounts and you start benefiting a lot of those benefits.
Good.
Okay, as far as the fees, they're all pretty similar. SMAs typically have a lower overall expense fee than mutual funds. Again, it kind of depends on the fund. Some mutual funds have very low fees. Some have upwards of 1.5 to 2% a year. So just important to realize there, but that's why we talk about commingling of assets. Now, how does that affect let's go back to the Poland Focus Growth. This is one of the managers that we have available to us, and we're going to compare the SMA versus the mutual fund. Now, the SMA has an expense fee, I think it's around like 0.45% a year is the expense fee. And then the mutual fund is 0.98. So there's a 0.4, what is that, a 0.53 difference between the two. And so when we look at this, we start to see some of these underlying fees that happen. The further that we go back, you'd expect the mutual fund to only be 0.5. Now, this SMA and mutual fund are invested in the exact same company. So we're comparing apples to apples here. But it's amazing to see the differences between, and we'll look at the 5-year. We'll just jump straight to the 5-year. So even though there's only a 0.53 difference between the SMA and mutual fund, there is a 1.31% per year difference because the SMA does not have all these hidden transaction fees and other expense fees. So if you're able to, the SMA does have typically a better growth potential than the mutual fund. Now, I know if we look at the inception, there's a different story, but this SMA has been around since 1989. This mutual fund's only showing since 2010 when that came about. So that's why I'm only going back 5 years, because that's a true head-to-head comparison there. And so SMAs typically outperform the mutual funds when they are like to like. And so that's basically the end of everything that I just wanted to share today as far as the topics of the commingling and avoiding overlap. Just be aware, you don't want to mix your styles up. Honestly, one mutual fund in a growth and one mutual fund in like a fixed income may be all you need in your 401k or other type of positions, because mutual funds on average hold over 100 different positions within them. So you're kind of broadly invested already just with one mutual fund. So more is not always more in that sense. But yeah, Lynn, do you have anything you'd want to
No,
chime in on?
I think great presentation. It was very helpful. Spot on with the commingling and overlap. That's a good focus to understand. Of course, we offer that service to all people that come into the office with our audits, and we have great partners that provide that technology to us, and we love to employ that on behalf of clients and prospects, friends, just information to help you make good decisions. So that's what we're here for.
Yeah, does anybody that's here with us today, does anybody have any questions on overlap or commingling of assets? So
You can unmute and do it verbally or just
yeah,
chat.
unmute verbally, or there's a chat box that you can enter any questions you may have in. We'll leave that open for just a minute or two. And if not, we will let everybody get on with their day and get the weekend started in a few hours. Or now, if you're retired. Every day's a weekend, right?
Every day's a weekend, right?
If not, that should be a goal.
Yeah, there you go. All right. Okay, yeah, that's very good. Good job. So we have some music playing in the background, do 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 do.
I don't think so.
Let's see, what's that one from? Jeopardy, I think.
Jeopardy, yeah, it's just not the same without Alex Trebek.
No, it's not. It's not.
You're welcome. You have a great day. Well, I will just add, yeah, if you guys have any outside accounts that you want an audit done on, if you want to see what type of overlap you have in your portfolios, shoot us over your statements. Either drop them off with one of the advisors or send it to one of our emails.
We also have an encrypted method at box.com that's very, very secure that we can forward to you, and then you just drag and click your statement into that, and
Yep.
and it's very secure. So yeah, happy to
so
do
we
that.
have
Of course,
secure ways of doing that.
as always, all of this service is provided complimentary. We do not charge any fees for any of those types of analysis opportunities, because we give out good. So it's a good thing.
All right. I think with that, we'll go ahead and just end this presentation. And thank
Good
you
job.
all for joining us. And if you have any questions, you can always reach out to us or any of the advisors here at Oxford Wealth, and we'll be happy to help you.
Take care. Stay well.